Welcome back, dear students and scholars. In this one compact lesson, we cover ASC 272 Limited Liability Entities. This is a small but practical topic. It is not about building a new accounting model for every transaction. It is mainly about entity form, financial statement presentation, and the equity section. The key areas are limited liability companies and partnerships, members' equity, statement headings, disclosures, and comparatives. ASC 272 exists because traditional US GAAP reporting language was built mostly around corporations. Many financial statement templates talk about shareholders, common stock, additional paid in capital, and retained earnings. But a limited liability company does not have shareholders in the corporate sense, it has members. So the standard helps the financial statement speak the correct language for the legal form of the entity. Small topic, but very visible when someone reads the balance sheet. The scope is narrow. ASC 272 has one subtopic, ASC 272 10 overall. It applies to limited liability entities organized in the United States that prepare financial statements under US GAAP. The main examples are limited liability companies and limited liability partnerships. So, before applying the rules, always ask three things. Is it a limited liability entity? Is it organized in the United States? And are the statements prepared under US GAAP? A limited liability company or LLC is described using three basic anchors in this guidance. It is an unincorporated association, it involves members rather than shareholders, and the members generally have limited personal liability for the entity's debts and obligations. That legal liability shield is the big idea behind the form. But remember, limited personal liability changes legal exposure. It does not erase the accounting need to present the entity's financial position clearly. ASC 272 also includes a tax classification reference. The slide lists four classic characteristics historically used in distinguishing partnership style entities from corporations: limited liability, free transferability, centralized management, and continuity of life. The guidance frames the partnership tax classification by reference to lacking at least two of those characteristics. For our purpose, treat this as a source based reporting lens. It is not tax planning advice and it should not replace specialist tax analysis. ASC 272 covers both LLC and LLP reporting. An LLC is a member based limited liability entity formed under state law. An LLP is a partnership form that gives partners liability protection, often seen in professional service firms. For ordinary operations, most accounting is familiar. Revenue, leases, expenses, depreciation, and accruals generally follow the same US GAAP principles. The visible difference is usually in the financial statement headings and equity presentation. The main accounting difference is not that every transaction suddenly changes. Most transactions stay familiar. The real difference appears in the equity section. A corporation talks about shareholders' equity, an LLC talks about members' equity. A corporation may show common stock and additional paid in capital. An LLC may show member classes, capital contributions, distributions, and allocations based on the operating agreement. The student shortcut is simple. With ASC 272, go straight to the equity section. When an entity restructures itself as a limited liability entity, the predecessor basis of assets and liabilities is carried forward. That means the restructuring does not create fresh start accounting or a new fair value basis just because the legal form changed. Historical carrying amounts, accumulated depreciation, and other book balances continue. This avoids artificial gains or losses from a form change alone and connects naturally with common control reorganization logic. A tax status change can create a deferred tax issue. If the new limited liability entity is not taxable at the entity level, existing deferred tax assets or deferred tax liabilities from the predecessor taxable entity may no longer be appropriate. Those balances are written off when the change in tax status becomes effective. Removing a deferred tax asset generally creates a charge to current tax expense, while removing a deferred tax liability generally creates a credit. Statement headings matter more than students sometimes expect. Each financial statement should identify the entity as an LLC or LLP. That small heading gives users immediate context. It tells them they should expect members' equity instead of shareholders' equity, possible absence of entity level income tax, and ownership language based on membership interests. In practice, preparers and auditors should check every statement heading and note heading for consistent entity identification. The main caption rule is straightforward. Use members' equity, not shareholders' equity. This is the headline rule of ASC 272. The caption tells users that ownership belongs to members under a membership agreement, not shareholders under a corporate charter. Once that caption is used, the same language should flow through the statement of financial position, statement of changes in members' equity, combined statements, and footnote disclosures. Consistency matters. If an LLC has more than one class of members, equity attributable to each class should be separately shown on the face of the statement of financial position or disclosed in the notes. For example, Class A members' equity and Class B members' equity may have different voting rights, distribution rights, or liquidation preferences. Users need to understand that capital structure. If there is only one class, a single member's equity caption may be enough. A deficit in members' equity is still reported in members' equity. Limited liability protects members from personal liability in many situations, but it does not hide the entity's economic deficit. If accumulated losses exceed capital contributions, the deficit must be shown transparently. The financial statements are reporting the entity's position, not trying to make the members feel better. If going concern uncertainties exist, those are considered under the relevant going concern disclosure guidance. Unpaid member contributions are shown as deductions from members' equity, not as ordinary assets. In the slide example, members' capital contributions are $500,000, unpaid contributions are $40,000, and net members' equity is $460,000. This presentation is similar in logic to unpaid stock subscriptions receivable in corporate reporting. It prevents the balance sheet from overstating assets when committed capital has not yet been received. Comparative statements are normally useful, but only when the earlier period is truly comparable. If the LLC has a continuous operating history, comparative presentation can help users see performance and equity changes over time. But if the LLC was newly formed through a restructuring, the predecessor period may not be directly comparable. In that case, disclosure is needed, and ASC 250 guidance on changes in reporting entity may become relevant. Disclosure focuses on explaining changes in members' equity. The entity can present a separate statement of changes in members' equity, a combined statement of operations and changes in members' equity, or disclose the changes in the notes. The format can vary, but the substance cannot disappear. Users should be able to understand opening balances, contributions, distributions, income or loss allocations, withdrawals, and ending balances for each relevant member class. ASC 272 is the core topic, but a few related standards may matter when facts require them. ASC 505 supports equity presentation logic. ASC 740 matters when tax status changes affect deferred tax balances. ASC 810 may matter if ownership interests raise consolidation questions. ASC 850 may apply to related party transactions with members. ASC 805-50 may be relevant for common control reorganizations and carry forward basis. Use these connections only when the fact pattern needs them. Let us close with the 5 memory anchors. Scope: limited liability entities organized in the United States under US GAAP. Basis: predecessor carrying amounts are carried forward. Tax: deferred tax balances may be written off when the entity becomes non taxable. Equity: use members' equity, show classes, deficits, and unpaid contribution deductions properly. Notes: comparability and equity change disclosures matter. If this helped you, please like the video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel. ASC 272 is complete, and the next ASC topic should begin with its own source check and proportionate roadmap.